All right. So in this video, we will show you how to invest into a diversified ETF portfolio. So we're going to show you some portfolio ideas that you can use and show you how the performance has gone in the past. Which obviously, we're going to show you some ideas here. But I really want to stress the fact that do your own due diligence. This is an ETF portfolio that has worked well for me. It's, delivered consistent returns in the past, and, it's been doing really well. And so do your own due diligence. We've given you the tools to research your own ETFs. And if you want to do a different one, or if you don't want to do any one at all, like it's totally up to you. You should do your own due diligence, but we're going to show you some diversified options that you can use today. So just to recap from what we've discussed, consider these things and then make your decision. We're going to go through some options today that kind of cover most of these things. They are, world ETFs, emerging market ETFs, and European ETFs. And so you can then decide what you want to do. But these are broad indexes that have a lot of companies within them. Now, the region that you live at really matters when you build your own portfolio, but only depending on what type of broker you use, because some brokers allow you to invest in different regions, as we have described in the brokerage video. This might, however, come at the cost of currency conversion fees. If you, for example, using Australian dollars to fund your account because you get paid in Australian dollars, having to convert that into euros to buy perhaps a European ETF will cost you money. So therefore, investing into ASX stocks will likely be cheaper if you can invest directly with Australian dollars. That way you would also avoid having to file other tax agreements, because there's different tax rates in the US and in Australia, for example, or in Europe. And so you can then, when you do buy stocks in the US, for example, sign a tax agreement so that you avoid double taxation, and you will therefore only pay the tax of the country that you live in. So this is something that's possible, but requires extra work, is more complex. However, it's very important then to note that ETF availability varies. Some of the ETFs we will show here will only be available in Europe. Some other ones will only be available in Australia. This is very important to keep in mind. Also, when you invest into an ETF from another country, with another currency, you're also exposing yourself to exchange rate variability. So when, for example, the euro grows quicker than the Australian dollar, and you have, say, euros and you invest them into the Australian stock exchange, then suddenly your investments will decrease in value, because if you had just kept the euro, you would have had a higher growth potentially, because the euro has gotten so strong comparatively to the Australian dollars that you have invested your money into. ETF options that exist depend on what's supported by your broker in your country. But as we have said also in the brokerage video, is that we show you two different brokers here. And we also give recommendations on others, but obviously it's all for information. But the Interactive Brokers platform allows you to invest internationally across different stock exchanges. So if you really want, you can certainly buy an ETF from another region, even though you might be in Australia or in Europe and you think I can only buy European or Australian stocks. It's not actually true, because with Interactive Brokers, you can very easily invest into other stock markets as well. So this is definitely something that is possible and that you can use to invest into the stocks that you really want to. And so we're going to go through this one here, for example. This is the first portfolio that we have here today. It's a 50-30-20 portfolio. It includes the MSCI World, which is, I think, 1,600 companies. We're going to go through them one by one, quickly show them. The iShares Emerging Markets ETF. So this is China, Taiwan, Japan, South Korea, these kind of countries. Don't ask me why they call it emerging markets, because in many ways these countries are more advanced in many things than, the so-called world ETF. But so that's why we want to include them, because maybe they might not have the same kind of performance as the world. The world ETF has the strongest performance in all of these ETFs. But as we said, the past doesn't predict the future. Maybe China and the developing world is on a big rise, and we want to, as investors, be diversified. And then when there's a shock in one area, let's say there's a banking crisis in Europe, then we still have the US and China and India and all these other countries doing really well, which drive positive returns for our portfolio. So that way we are safe throughout the world. And so if we want to have a look at these ETFs, we can then see that we go to the world ETF, MSCI, like the core world ETF. We've seen it during the researching your ETF video that we showed before. It's a very big fund size. It has very strong growth. It's primarily US based though. It's a world ETF, but it is US companies in it by 70.5%. Important to consider. These are good companies, they do really well. As we can see, the price has been pretty good. If you had your money in there in 2010, $2 turned into, the percentage, sorry, the percentage. You make a 500% gain, so that's really good. It's a physical replication, it's been around. I'm not gonna dwell on it. We know this one. So let's look at the other one. So the emerging markets IMI ETF. So if we put this into the Just ETF research tool that we have, we can then see here, accumulating as well, is a pretty damn big one. 21 billion fund size, 3,000 companies in it. Very good. Accumulating physical, low fee tier of 0.18%. Over the past 5 years, 60% growth, consistent growth, maybe not quite as strong as the other one, but still very strong. And, it's another sector. If we look at the countries, it's China, it's Taiwan, it's India, it's South Korea, it is Saudi Arabia, Brazil, South Africa. You see, it's other companies, Taiwan Semiconductor, so it's a lot of manufacturing, Samsung phones, Alibaba is Chinese Amazon, kind of like, delivery for, like sourcing stuff, delivering stuff, really big company, Meituan, big companies, big Asian companies doing really well. Solid ETF, good returns, accumulating, physical replication. That's what we want. The other ETF that we have here is the Amundi Stoxx Europe 600, so some European exposure to have some growth of that as well. This ETF, 10 billion euro fund size, 608 holdings, not quite as many, but still really good, accumulating 0.007 fee tier. That's insane. Like that's nothing. That's super, super cheap. 5 years, 114%, very strong growth. So that's what we love. Low fee tier. It's been around since 2013, so it's been old. It's accumulating. It's got UK, France, Switzerland, Germany, Netherlands, Sweden, European companies, SML Holdings, Novo Nordisk, Nestle, AstraZeneca, biochemical company, Shell. So that's some oil. So yeah, important to consider fossil fuels. Do I want to support that? Something we're going to go over as well in some other modules, if you want to invest sustainably. But yeah, very good ETF, very strong returns, financials, industrials, healthcare, very good sector diversity. So yeah, it's looking good. It's looking good. So this is what you can look at. These are strong established sectors. Like there's 600 companies in this thing, right? In the European one. There's 3,000 in the emerging market one. There's 1,600 or so in the core MSCI world. It's very, very difficult for anything to go wrong if you put your money into this, because there's just so much behind it. There's so many companies that are doing well that it's a very safe option. You're tracking the market, you're just letting the market work for you. 70/30 portfolio, it's very popular. You have 70% world, 30% emerging markets. That way you're covering Asia and the US, which are, the biggest economic players at the moment in the world. So also a very safe bet. Very, there's the dividend ETFs. These ones pay dividends out. If you want to have some income on the side, if we have a Google of this one. Okay, so the dividend is 7.88% for the emerging market one, and about 5.4% for the global one. And it's good if you want to have some extra income on the side to consider these dividend ETFs. They pay high dividends. They have, good payouts, and it's good to consider. But also, it's always, I find with dividends, good to ask, like, why are they paying them out? And there's definitely strong portfolio options, but in this course, we're more going on the growth portfolio. I think because for the others, like if they're not investing into, they're giving out money to shareholders, these companies. The dividend is basically payment from a company to the shareholder as a reward for keeping the share. But if they had just used that money to invest into the company itself, then, maybe it would grow more. So I'm always thinking, like, when the rate is really high, like, why are they doing that? And why are they not investing it into the company? And if we look at them, I mean, maybe they have had significant growth in the past, but I found that some ETFs in the past that have had high dividends, it may have been at the cost of its annual growth rate, and maybe they don't grow as quickly as, say, a growth portfolio over time. But this one has actually been doing pretty well, and it's been paying dividends. So yeah, that's a pretty good sign, I guess. But yeah, something to keep in mind. Definitely something to keep in mind. I'd rather have a stronger growth than having, a payout for dividends. But yeah, this depends on your preference. This could be a really good one if you wanted to have some cash flow on the side and wanted to have a way of having some money that's being paid into your bank account as passive income. Dividends are a very strong tool for that. And they could really help you make a lot of money in the long run. So this one has 105 company diversity as well. Company diversity might not be quite as strong. So something to consider. So just to reflect, dividends are profits that are paid out from companies to their shareholders that, as a reward for keeping their share, which they could have used to instead invest into their company, but they decide to reward their shareholders. It's a good source of passive income. I think for a starter or, someone that has been investing for a little bit, it could be useful to first start with a growth portfolio and just building up a bit of a base, and then perhaps splitting the portfolio, like if you say go for a 70/30 portfolio, having 70% in world normal growth ETF and then 30% emerging markets growth ETF, and then instead, perhaps combining it with a 70/30 dividend ETF as well. And therefore dollar cost averaging, as in spending every month a certain amount to buy these ETFs together, and therefore having, like, let's say, a combination of 35% growth world ETF, 35% growth dividend ETF, dividend world ETF, and then the emerging markets growth 15%, and then another 15% of the emerging markets dividend ETF. So therefore, you have a 70/30 combination of world and dividend, because as we saw, the dividend ETFs are also slightly less diversified and have less number of companies within them. So just a short reflection there. So then we've got the sustainable ETFs, and we have another ETF video that explains what a sustainable ETF is. But basically, just to reiterate, they do exclude certain industries from their portfolio. These socially responsible ETFs that we've chosen in this portfolio have excluded, for example, fossil fuels, for example, tobacco, alcohol, weapons, and various other industries that are considered, that are just, excluded once there's a certain business involvement with these industries. They have been excluded from that portfolio. So in this case, we have 50% world, 30% emerging markets, and 20% Europe again, the 50-30-20 portfolio. And, yeah, they exclude all these industries. And to show you kind of what historical growth has been looking like for that, if you had, say, invested 10,000 euros into that kind of portfolio, you would have this kind of portfolio. Now, it's also important to note here, we have, some USD and some Euro stocks that, we always try to invest in the same currency, ideally, if you have, in a certain brokerage account, because otherwise you have to pay currency conversion fees that can be expensive. So try to avoid investing in a different currency. Either stick with US dollars or stick with euros or whatever currency you have to invest in, and, try to stick to it. If it's not possible and there's only this ETF that you want in this currency, then, maybe it's not possible, but yeah, this is just a general recommendation. But so in this case, you would have 10,000 euros invested 5 years ago today, on the 22nd of March, 2022, when I recorded this video, you would have made today, on the 22nd of March, 2025, instead of 2020, 18,715 euros. You would have made 8,715 euros. That's about 17.42% per annum, which is pretty insane. It's really good. So yeah, it's very strong over time. And this is, something that you can start off with. But I mean, yeah, this assumes you would have invested 10,000 straight up. So it's always good to start small and start every single month to put a small amount in. If it's like, a little bit of your savings, and then just be consistent over time and invest that way. So yeah, that's about that. Then you have the same for 70-30. You have, the sustainable portfolio option, which is good. Now, for the Australian portfolio, we have here a 50-30-20 portfolio, basically, which includes world companies and also emerging markets, and as well the European market. So you have a very global exposure. You can also, if you want, add an Australian portfolio or an Australian ETF, which has Australian companies in it. It's something worth considering, as they are very strong and they have had consistent, strong financial returns over time. But if you're starting out, this will be a very solid portfolio that allows you to be very globally, safely diversified with a strong growth over time, which is spread over thousands of companies, have grown consistently, strongly in the past, with a global exposure to a strong US focus, with a strong emerging markets like Taiwan, China, Japan, South Korea, and European countries represented as well, like France, Germany, Italy, UK. I will not go through each and every one of these ETFs in this section of the course, but I do very much recommend you to have a look online and check each and every single one of them out to see if they actually meet your needs. We're going to go through several here, so feel free to make modifications as you see fit, but this is a recommended, portfolio with a strong growth past. While obviously past performance does not indicate future performance, does not predict, but it is an indicator, and would therefore still recommend to check them out, each and every single one. If we check the history of this one, with this, one in mind, over 5 years, if you had invested 10,000, you would have earned on average 11.28% per annum.
$6,222 Australian dollars would be yours after 5 years, which is honestly pretty solid. If you prefer, another very common one is the VGS and IEM combo, a 70-30 portfolio where you do not have Europe, but you have mostly US stocks in this VGS component, international shares. But if you check the country diversity, definitely consider the how to research an ETF portfolio videos with that PDF that's also there that gives you guidance, and check out the different factors here to be aware of the country diversity and so on, because VGS is a world international shares ETF, but it has a very strong America component, so it's mostly US stocks, so you have to be aware of this. And the iShares emerging markets one is very good. It has mostly Chinese, Taiwanese, Japanese, South Korean stocks. Once again, strong growth in the past, thousands of holdings, which is very good to be safe. It is a great starter portfolio because there's not much that can go wrong, and you can always add a Europe or Australian company perspective into this portfolio as well. Now, this next one is a more advanced kind of sustainable portfolio for Australia. It includes the VESG ETF. It includes the IEM, which is the Emerging Markets ETF, which is not a sustainable ETF, but it is still in there to have that emerging markets exposure, since it is quite difficult to find emerging markets or Europe ETFs which are sustainable. So sustainable ETFs is something that we will cover more in Module 6, just to let you know, but to kind of guide you through what these ETFs have here in terms of why they are considered sustainable or ethically conscious. So coming to the first one, which is VESG, basically it has a bunch of exclusionary screens. That means it excludes industries that are considered unsustainable for it, which includes controversial weapons, which are companies that produce, for example, chemical or biological weapons and their components, including all precursors, munitions, devices, or equipment specifically designed for and used to directly in connection with these weapons. There are different definitions to specifically explain this more, and we will have this linked as well in the course. So there's nuclear weapons, which it excludes. It includes civilian firearms, conventional weapons, so companies that manufacture military weapons that are, integral, also tailor-made components for these weapons. And then, here it also starts specifying revenue. So if they derive 5% or more revenue from tailor-made products and services that support military weapons and so on. It excludes tobacco and tobacco-based products. If there is, greater than 5% of revenue to supply tobacco-related products and services and so on. It excludes cannabis, gambling, so if it has 5% revenue or more from owning or operating gambling establishment, if it has 10% revenue from manufacturing specialized equipment used for gambling. It excludes alcohol if it, derives more than 5 or 10% for alcohol related activities. Adult entertainment as well, non-renewable energy like nuclear power, oil and gas, thermal coal, unconventional oil and gas, and controversies like breaching of international treaties and conventions, which basically excludes companies that fail to comply with UN Global Compact principles, which cover human rights, labor standards, the environment, and anti-corruption. And they basically use the Morningstar Sustainalytics controversy ratings, which basically screen companies that fail to comply with these standards, which then are excluded accordingly. The ESGI ETF basically follows the MSCI World X Australia Index, which then screens out companies based on the following criteria, which basically they will exclude adult entertainment Once there is derived 5% or more of aggregate gross profits from that type of industry, then it does that for alcohol too, and then it excludes animal welfare that are involved in any sort of commercial animal husbandry for the purposes of food production. It will exclude civilian firearms, conventional weapons, controversial weapons, fossil fuels, gambling, genetically modified organisms, nuclear power, nuclear weapons, tobacco, soft drinks, which is honestly a bit surprising that it even excludes soft drinks. It then mentions that remaining stocks are basically researched for MSCI ESG research data to look at if there's any risk associated with them, if there's there's a low sustainability score. They basically rate them from AAA to CCC. Basically, this means that a AAA is like a super well sustainable fund, has a low risk of being unsustainable, and CCC would be, I guess, a very unsustainable rated company or fund. Now, both the VESG and the ESGI have a strong US stock component. So these are mostly US. So it's very important to keep that in mind. Once again, look at the ETF investing framework for researching to consider the weight of US companies to other companies in this ETF, and then make your decision how you want to weigh that portfolio. The reason why we did, this 30-30-20-20 is that way we have, maybe about 30 to 40% of US stocks in the whole portfolio, and then you also have a strong, Taiwan, China, Japan, Australia as well, with the GRNV component. So this is how you're going to stay diversified in this aspect. Considering the ESGI index only has about a 40% US component, which is still large, but will allow you to balance this out. Now the GRNV is like an Australian ETF, which has mostly Australian companies, also had a very strong growth trajectory. We'll go into that in a minute. But just to show you what it excludes basically, I believe, the exact same as the ESGI. So it excludes adult entertainment, alcohol, animal husbandry type of business, civilian firearms, conventional weapons, controversial weapons, fossil fuels, gambling, GMOs, nuclear power, nuclear weapons, tobacco, soft drinks as well. And then it also has this ESG rating from MSCI that it will consider to look at sustainability risks of that portfolio as well. Now, if we look at the growth over the last 5 years, it's pretty decent. If you had 10,000 over the last 5 years or 5 years ago, you would now have about 15,800. So about 10.52% per annum growth, which is honestly pretty decent. This next portfolio is a slightly different version of this, kind of similar, but as you can see, the ESGI component was taken away, and instead you have the IEU. That just gives you some more EU exposure, but note that these are actually not sustainable ETFs. That doesn't mean they are unsustainable. It just means that they haven't got the sustainable exclusion criteria applied as the other ETFs have that we have discussed in the previous section. So if we look at the past growth, we have about a 10.03% per annum, so 5,471 you would have earned over this time, and it's maybe slightly less, but you have a very safe haven of your investments because IEU ETF from basically Europe has so many companies in it. It has I think over 500 or 1,000 or so, which basically gives you a very well diversified portfolio. Now this is the Australia portfolio, and this is Australian Stock Exchange companies, ETFs that you can buy, but I want to stress again that you can use the Interactive Brokers portal as well to consider buying European ETFs if you want to, because it will allow you to convert your Australian dollars into euros to buy the ETFs that we mentioned in Europe as well. That will allow you to get the same kind of balanced portfolio as well, as mentioned in the Europe video. So I would definitely recommend to check that out as well to see if any of those interest you there. Another ETF that I have bought, which is not a sustainability screened ETF, but one that has very much grown very well for me in the past, and it might do so in the future as well, is the NDQ ETF. So feel free to consider sprinkling this one in as well. But I would very much stay with a core investment strategy and don't get clouded by your emotions and other people's thoughts and tips. Just stay clear, just follow the market, and you will be rewarded in the long run. And yes, the ETF that I meant before was NDQ, which has worked really well. The NASDAQ 100, top 100 companies, it has worked very well.
And there's, key mistakes in how to avoid them. These are not something to be scared of, just something to consider. You want to avoid overlap, so check for duplicate stocks. If you choose to invest into multiple ETFs, make sure that there's not a portfolio overlap, because that will impact your returns or your diversification, because that means you're just buying the same thing with a different name. So make sure that the holdings are different. We've explained that in the How to Research ETF video, but just reiterating it here. Easiest way to avoid portfolio overlap is to, as we said before, check the top holdings of each ETF that you are looking to buy, or your portfolio of ETFs, and then looking at the top 10 holdings. There might be small overlaps of like 0.1% of an ETF portfolio, but let's say if two of your biggest ETFs have, let's say, the top position being Apple, and there's 10% of the whole ETF invested into Apple, then maybe you could consider that a strong portfolio overlap. So you want to avoid that scenario. Limit the portfolio changing, because frequent trading increases the costs. You pay trading costs. Oh no, trading fees, more money paid. That means less that you can keep in the long run. And then another problem is following the hype without research. Don't blindly follow advice. Verify facts before investing. And then stick to a clear plan. Set a plan, set a long-term goal, and then just, stick to it and stay disciplined that way. It's very important. And, it's gonna be really rewarding for you in the long run to stay with that plan. Another really important one that I would add is that some people start being super optimistic about, having watched all these videos that I present here of, oh, this is so good opportunity to make money. I'm going to put a lot of money into this. And I'm going to put, let's say I earn 2,000 euros and I start putting 1,200 or something every month into ETFs. And I think, oh, I'm going to get rich. And then at some point, maybe you experience a market downturn and then you have lost a bunch of money. So you really want to start small, and like it's not a bad thing to start small. It's actually really good to just get a feel of how it works and how to invest. And then once you become more experienced, you can invest larger amounts proportionally to your rising income. And we've all explained this in the account setup or the account management video, where we start small and then we gradually build up as our income increases. So because many people, they start big, then they get scared when they get frustrated about the amount of money they put in and how there may be a short-term market downturn. And then they might stop investing after that. And they think, oh, look, this hasn't worked for me. It just hasn't worked. And then maybe 10 years later, their ETF would have doubled in value or something, or tripled in value, And so it's not a short-term game. Start small and don't invest more than you are comfortable with. Because if you invest too much and you can't sleep at night, there's no point. Better to start small and stay consistent. So key takeaways: start simple ETF portfolio, then scale up as you learn. This is a really good one to start. You can invest, 100 euros, 200 euros every single month or something, depending on your financial situation, and then automate your investments with an ETF savings plan. Have an automated plan that takes your money from your bank account to invest into an ETF every single month. And you can do that super easily with Trade Republic that we've recommended with the broker. There's a way to set up a plan where you can invest every single month, take your money from your bank account.
Let's assume you invest in the 50-30-20 strategy and you say start small with 100 euros a month to invest, and you put 50% of that, so 50 euros, into the World MSCI World ETF. You put 30 euros into the Emerging Markets ETF, and you put the 20 euros into the European Stocks 600 ETF. Then you would have a balanced portfolio that has worldwide exposure and delivers strong financial returns.
You automate that, and then you stay patient. It's not a sprint, it's a marathon. Wait 10 years, do that every month, earn your money, save some money, put it aside, invest, and advance your financial education to grow wealth. It's really going to pay off in the long run. So yeah, that wraps us up for this video.